CITI's 2017 Global Property CEO Conference. This session is for investing clients only, and if media or other individuals are on the line, please disconnect. Disclosures are available up here and on the webcast on the Disclosures tab. For those in the room or the webcast, you can sign on to slido.com and enter code 7624 to submit any questions if you don't want to raise your hand. We're pleased to have with us Gazit Globe and CEO Dori Segal. Dori, we will turn it over to you to introduce your management team and provide a couple of minutes of opening remarks, and then we will begin Q&A. Dori.
Okay, so I'll start with my prepared comments. Gazit Globe, to those of you who don't know, is a global owner, developer, and operator of shopping centers. We're predominantly in North America, Northern Europe, Central and Eastern Europe, Brazil, and Israel. Until last week, where we closed a major transaction in the history of the company, we had interest in over 400 properties, about 70 million square feet, and about $22 billion in assets. When you look at the Gazit's business today, I would probably divide it into three buckets. Two wholly owned subsidiaries, our business in Israel and our business in Brazil. Three public entities in which we are the largest shareholder, which are Atrium, Central and Eastern European business. CITI, which is the Nordic largest owner, developer, and operator of a shopping center similar to the Gazit strategy, supermarket anchors and daily necessity tenants. First Capital, a company in Canada we started in late 1996. And the third bucket is a financial instrument on the balance sheet as of the second quarter, which is our remaining 11.5% holding in Regency Shopping Center, which was merged with Equity One, or Equity One was merged with Regency. Last week, the deal closed on Wednesday. And when I look at Gazit today, after 25 years, we're probably at a somewhat of a junction in the history of the company. We either founded or built the businesses that we own from start. So if you look at Equity One, it was a wholly owned subsidiary of Gazit until 1998 when it went public as a REIT on the New York Stock Exchange. When you look at First Capital, it was a private company until 2000, in which we at that time acquired an existing shopping center company that was publicly traded in Canada and merged our business in Canada into that company. CITI was acquired in 2004 with about $150 million euros equity market cap as compared to $2.25 billion today, $2.25 billion. And Atrium, that was acquired in 2008. The Israeli business was started at 2006, and we first got into Brazil 5 years ago. However, we've been extremely aggressive in buying and developing over the last 2 years, which we think was very opportunistic. So what is Gazit today? Gazit is a rare opportunity, probably very rare, to invest in a high quality portfolio of shopping centers at a significant discount to NAV. And this discount has probably been, I wouldn't call it created, but evolved over the last 3-4 years, right around the time where our businesses that we own has done their best. So while you saw Equity One, First Capital, CITI, and even Atrium becoming much larger companies with much more liquidity, with much more investor interest, high credit rating, liquidity, I think it's probably logical why investors took less interest in Gazit when you can buy the underlying businesses more or less at the same price. And you saw that gap in the difference between NAV and the stock price opened up. I think we in Gazit understand it. And one of the things that we've done is a year ago we announced a 3-year strategy in which we are going to fundamentally change the business of Gazit. And if you ask me, today we own 4 public, or we have major interest in 4 publicly traded companies and 2 wholly owned subsidiaries. If we sit here 2 or 3 years ago in the same conference, this situation is probably going to be fundamentally different, where the majority of our business is going to be in private real estate. The question is not, can we get it done? Because I think it's a very easy thing to do. You can sell everything you own cheap and go and overpay for real estate, and the next morning you're a real estate company. Well, that's obviously not what we're going to do. And I think the trick is to get to what we want to get, keeping in mind earning per shares, valuations, timing, and of course, leverage. So all those things are what Gazit management team is busy doing today. The other thing that I would tell you is Gazit management team has two things going forward. First of all, it's extremely aligned with the interest of the shareholders. All of our team members has been with us for quite a long time, whether it's Adi Jemini, our CFO, other executives in the company, some of them are here in the room with me. And we all have equity in the company, both the chairman and myself. 90% of our net worth is invested in this business. And if you go the Israeli public markets, they don't overpay you to run a public company. On the contrary. So I don't think we have any vested interest in this business other than our equity. We have a very clear strategy as how to get there, and that's what we're going to talk about in the next half an hour. And the one thing that is really going for us, which, although we're not enormously busy right now, our operating businesses are all performing very well. Same property NOI growth, leasing spreads, the quality of the real estate. There is a continuous, very clear program by the management of the operating businesses of continuing to develop, redevelop our existing assets, add density, recycle capital, in other words, continue to sell the bottom of the portfolio and reinvesting the capital into expansions and redevelopment and improvement of the higher end of the portfolio, and opportunistically acquire assets within the trade areas that we exist in order to continue to grow the business. So that is what Gazit is today. The one thing I would point out is there is a fundamental change that is happening in our business. I'm sure everybody knows about it. Retailers are going to need less square foot to sell the same dollar over the next 5, 10, 15, and 20 years. I don't think this is a secret. If you look at the organization, the Gazit Group, over the last 6 years, or since 2010, we have aggressively invested about $15 billion group-wise, and we've also divested of over $4 billion worth of assets. We will not own, and we don't own any asset we don't think is going to continue to perform well with the new environment of retail. And that environment is not only impacted by online and technology, but it's only impacted by fundamental change in demographics in most Western countries, or Europe, or North America, or the markets we operate in. And that fundamental demographic change is people are coming and living more in the core and according to transportation lines. So you definitely see one of the results of that. The average home is getting smaller, the average family is getting smaller, and obviously consumer habits and consumer baskets are changing. And all that, I think, is very clear to the retailers that sits in our centers. Just one anecdotal fact, over 30% of the tenants in our shopping centers today have no inventory. So we were one of the first to be very aggressive on medical, fitness centers, when we had a huge debate with our supermarket tenants, which are our major tenants. When we started in this business, there used to be a clause where you couldn't put a fitness center in the shopping center. Fitness center customers are the best customers for supermarkets. They buy higher grade food, higher grade cereal, higher grade meat, vitamins, all this kind of product that supermarkets love to sell. And it took us, I say, probably almost a decade to get our supermarkets on side with the fact that a fitness center is probably one of the best co-tenancy to supermarket, provided, of course, you can reallocate the parking in a way that doesn't interfere with business. So our business is very much daily necessities and services, less fashion and soft goods. We started this 10, 15 years ago because we thought it would be less sensitive to economic cycle. As it turns out, it's also a lot less sensitive to the new development in retail and online and technology, which we're all experiencing. I'm going to just end my prepared comment with one with one thing that I think bears a lot of difference to the changes we're trying to make to the business. If you look at Gazit in 2008, 2009, this organization at that time, in those 2 years, invested $3.8 billion, 2.2 on the operating company level in acquisition, development, and real estate related activities, including buying back debt and buying back stock. In the Gazit level, we spent about $1.5 billion at the time buying stocks of the subsidiaries, buying back our debt, and buying our own stock. I think that the only reason why I mention it is because this organization is very well accustomed to making aggressive and decisive moves when they are necessary. We had a strategy that worked very well for us over the last 25 years. We were major equity investors in all the businesses we own. And perhaps somebody could go back and say in hindsight, look, you could have created an organization that is structured with fees to Gazit and all kind of co-investing with the public subsidiaries. Well, in hindsight, it might have been a good idea. We didn't do this. We were the straight larger investor in every business we were involved in. And I think all our equity holders in those businesses, ourselves included, have done very well. But what worked for us very well in the last 25 years might not necessarily be the best business plan for the next 10 years. So our goal is to change the company, become a much bigger owner of real estate as opposed to stakes in public companies. And I think that's what you're going to see us do in a very, very short term.
Okay, so I'm just going to say again, you can sign on to slido.com and enter the code CITI17 to submit any questions if you don't want to raise your hand. The opening question from me is, what differentiates you from your property sector peers that you expect will result in outperformance in your stock over the next year versus those peers?
Well, I could have a long, smart answer, but I'm going to take the short route. I think what differentiates us is a cheap stock price and an ability to execute our business plan without going to the equity markets. And I think that is a very good position to be in. So I'm going to...
Okay. So let's talk about the Equity One Regency deal, as it is transformational for the group. If you can explain what the rationale for the deal was from Gazit's perspective, and what are your plans for this holding going forward?
Okay, so I'm not going to get too much into it as the deal was, I think, very well explained by Regency and Equity One. The short of it is that the number 2 player bought the number 3 player. The portfolios are almost a perfect match geographically. I think Equity One had probably a slightly higher growth profile in terms of its business. What made it very attractive for Regency, I assume, and what made it very attractive for Equity One shareholders, ourselves included, is the ability to de-risk the business at the same time at getting a nice premium and overall end up with an investment that gives you more cash flow per your proportionate share of the combined entity, while you have a lot less risk in the new holding of the combined entity. So that is very simple. As far as Gazit is concerned, Gazit for the first time has actually, in effect, exited a business. We're not involved in the management of Regency. We are definitely free to do whatever we want over the next few years. And as you all know, the business that was founded by Chaim Katzman in 1990 did start in the States. This is the market that we know best. We have relationship here. We know people. People know us. There are certain markets we know extremely well. So I think that might open some opportunities for Gazit, maybe not by the end of this week, but in the near future.
So to follow on about opportunities and investments in the US, there aren't currently many deals being done by property owners or by the US small owners. So where do you think you as a group can find and create value, and why?
So first of all, I think anything we're going to do in the US will still require us to go back to our board and present a clear business plan. But I think one thing you can definitely characterize the U.S. market is probably in contrast with many other markets in the world, that is very liquid, it's very large, and at least from what I know, always have room for people who can write a check and buy a piece of real estate, assuming they can get up in the morning and go to work and make that piece of real estate better. So if you put all those fundamentals together, and you combine it with one of my first statements, which is I think retail is changing, and I think Gazit has a unique proposition in terms of retail, combining what I call community services with basic daily necessity retail in a mixed-use environment. I think if we're patient, I think if we're prepared to go to work, I think there's going to be opportunities in these areas. I think our advantage is that we are, in this sense, very flexible in terms of what we can do. We can get into a situation and become a 50% owner of a property that needs change or needs repositioning or redevelopment. We have a lot of experience in this area. As you know, most of our companies, the major business in which we made the most amount of money on the real estate side was the redevelopment and repositioning and assembly business. So I think this is a real competitive advantage that we have. The other thing is I would characterize us as real estate guys that understand finance. We're not finance guys that understand real estate. We're real estate guys that understand finance. And I think as such, we could probably be of great value to existing investors in existing real estate that could use some TLC on the real estate side with deep understanding of the financial market and ability to finance properly. So I think we're bringing a lot to the table, and I think give us some time, I think we will probably be able to make a few bucks.
And in terms of US markets, you think along the same lines as where you already have knowledge, where Equity One has been?
In terms of the
geography? Yeah.
I think I prefer to comment on that probably at a later stage. We have not, we've spent in the last 10 years building Equity One, being a very supportive shareholder. We haven't really looked at other transactions. In the last 6 months, all the Equity One team and the side of Gazit that dealt with the transaction was busy with completing the merger. I think when we're prepared to make a few more or more concrete statement in terms of where we're going and what we're going to do, we'll probably announce it.
Okay. So just thinking about your whole portfolio and your geographical exposure, I think North America is still is a little below 50%, a third in Europe and the rest in Israel and Brazil. Are you happy with that footprint? How do you think about value geographically across your business?
So generally speaking, the answer is yes, we are happy with that mix. I would say that the one thing that may not be so apparent, our exposure to Brazil is probably a little higher than the 7%, given the fact that the Brazil business has no debt, while the other businesses have some debt in one form or another. So I would say that generally speaking, the one fundamental call that has to do with geography that we have made, I would say in the last 10 years was Brazil. We have gotten into Brazil about 5 years ago, very low key. We spent the first 2 or 3 years really trying to understand the business. To be more specific, I don't think we've gotten into Brazil. I think we've gotten into São Paulo. That's the only market that we're active in. About 4 years ago, we appointed, one of our key executives from Miami moved to Brazil. This is Ms. Mia Stark, who's sitting here. And in the last 2.5 years, we've been extremely aggressive in both acquiring assets for redevelopment, repositioning, and actually completed last December or December 2016 our first ground-up development. So this is definitely a market we're very bullish on. I would say that unfortunately in the last 3 months there is a bit of an optimism wave in Brazil. So things have gotten slightly better, probably a little too soon for us. We've invested so far a little over $600 million US in Brazil. We were hoping to get to a little bit larger portfolio. So we're still actively looking, but things has gotten slightly tighter in the last few months.
And US versus Europe?
Sorry?
US versus Europe?
US versus Europe is an interesting discussion that if you were part of Gazit's management, it's a discussion we often have. And the discussion starts first by asking ourselves, are we comparing apples to apples? So an 8% FFO yield in Atrium versus 5% FFO yield in Regency, are we comparing the same thing? And I think the answer is, as usual, yes and no. But I think fundamentally speaking, we all have to recognize that our business has a 10-year increments. If you look at our largest development, even on the property level, Iso Omena, Cinema City in Tel Aviv, which is 100,000 meter, a couple of large properties we've done in Toronto, in Warsaw. I haven't done a large development in my career that took less than 10 years. So when you're talking about large real estate pieces that takes 10 years to mature, the timing on a real estate business or a company is probably the better part of 15, so maybe 15, 20. So you can't judge geographies by the current economic condition. The common theme right now, everybody's sure that the US interest rate is going to go up and Europe is going to stay low. So most likely, U.S. interest rates are going to go down, and European interest rates are going to go up. I don't think we have an opinion short-term where economies are going to go in our decision-making process. What we do have that is very important to us is to be in markets, trade areas, or countries, or maybe even better, cities, that we believe in the long-term vibrant of the businesses as relates to shopping centers.
Okay, I'm going to take a question from the floor which has come through here, which actually is also a question I've got here. But talking about Europe and your Atrium and CITICON subs, the idea of putting them together and gaining geographical spread and also efficient management and economies of scale. So, you know, how do you think about a tie-up of those two subs?
Yeah, well, first of all, I think it's a fair question. I want to point out a couple of things that one needs to consider if you think about merging Atrium and CITICON. First of all, those are markets with different risk characteristics. If you look at the Nordic, it always reminds me a bit of Canada. It's about 35 million people region, highly educated, highly transparent, very organized in terms of rule of law. I would say high degree of certainty in the municipal process, a high degree of involvement, by the way, by municipalities. So I don't think you're talking about merging apples and apples. So as much as there are synergies in probably merging every two real estate companies, they might not be as apparent as they look from the outside. So that's my first observation. The second one is CITICON has two major shareholders, one Gazit, who owns 43%, and one CPP, IB, who owns about 15%. In Atrium, Gazit owns a little shy of 60%. So I think that's probably a different deal than, to those of you who remember, there was a time where we did a transaction where we merged a large portfolio that was owned by First Capital into Equity One. At that time, Gazit owned 60% of Equity One and 60% of First Capital. We basically appointed two special committees, and the two management of the two businesses negotiated the best transaction that was best for the businesses to come out with the best outcome. Gazit was absolutely an indifference on what would be the pricing of the transaction, and the assumption was when the two management teams of the two companies negotiated a deal, they came out with the best deal for the companies, and I think that's how the market perceived it. I think it's a bit more complicated to do when you are a shareholder on both sides and there is a third shareholder who has only one interest, which is to buy Atrium as cheap as it can. So I'm not suggesting it's not possible. I'm just saying it's not as simple as it looks from the outside.
Okay. I've got another question from the floor here. It's about valuation, and I suppose it touches on strategy. But if your shares are trading at a discount to the value of its components, why not distribute the shares of underlying interest to your shareholders and immediately surface value for all?
Well, first of all, in a world that is free of tax, it's probably a good idea. Unless you look at some of your subsidiaries as your cost of capital to do the next deal. And I think that's very important to remember. We created, I think, a wonderful portfolio of shopping centers that, quite frankly, is poorly structured. That's what it is. When you look at it, even me as the management of the company, you could say, look, why didn't you think about it 15 years ago? I don't know, we didn't. We were busy running a business of real estate. So when a portfolio of great asset is poorly structured, I think the first thing on the agenda is to properly arrange it. And that could be by selling one part of the portfolio, maybe by having a partner and buying one side of the portfolio. I also want to tell you that I think in Europe we have a lot more flexibility from tax perspective than we have in North America. What you saw us last week doing, which is just coming to the market and selling shares, I don't think it's something you're going to see very often, because it's very difficult for a business at the age of our North American business to just liquidate without having much more planning, or perhaps a business that already exists in the States with some tax shelter in the form of interest and depreciation that will allow you to be a lot more efficient in the way you sell the business. So theoretically, it's a good idea. I'm not sure it's possible. But everything in Gazit today is on the table. And if tomorrow our new beloved president is going to take corporate tax to zero, there may be other considerations.
Okay. So I wanted to, as part of the strategy presented 18 months ago, there was, you talked and you talk about deleveraging the business at the parent level and also at the subsidiaries. Where are you in this process, and what do you see as optimal levels for the current structure?
So I'm going to make a couple of comments, and then I'm going to let Adi Jemini, our CFO, add a little bit to it. So first of all, strategically speaking and fundamentally speaking, we think the leverage is a value issue. The less levered you are in this current environment, and according to what the market is telling you, and I think this is definitely a place you should listen to the market. We sometimes don't listen to the market in some real estate decisions, and we do what we think is right, because we feel on that part our opinion matters a lot more. I think when it comes to financing, when it comes to leverage issue, when it comes to dividend issue, you should definitely listen to what the market tells you and at least consider it in your decision-making process. So because we absolutely agree that leverage is an issue of value, we have, as you know, started already at the end of 2015 with a fairly large equity offering, which was not very popular among our shareholders, although most institutions, including Northstar, which is the largest shareholder in Gazit, took their proportionate share in the offering. Excuse me. We're starting delivering the company, and we are moderately going at a pace of 3 to 4% a year, which is expected to continue over the next 2 or 3 years, absent what I call a rating event. If we had a clear idea from the rating agency that this will get us somewhere tomorrow, we might deviate from that pace at one point. I also think that one thing that I think is a bit overlooked by investors, we have brought over $1 billion US of development over the goal line over the last couple of months. Between Iso Omena, we're developing a very large asset in Warsaw, a couple of large developments in First Capital, a large shopping center that we've developed in São Paulo that opened in December 2016. by the way, at 97% occupancy, which I can tell you in North America, I have never opened a development at 97% occupancy, which shows you that Brazil has quite strong underlying demand for good product. And another 14,000 meters of retail in Israel, which is now under construction and leased. In the last 6 months, the development profile of this organization, since we did not add any new development asset to the balance sheet over the last 2 years, right along with the top tier players in North America today, I don't think anybody did. As interest bottom, people were more cautious, as opposed to financial players who said, okay, we can't buy it for enough, let's develop at 7. Well, guess what? Not everybody can develop at 7. So I think that is also one de-risk factor that is not so apparent. It will be apparent over the next 18 months through the actual AFFO or cash flow, whatever you want to call it. Adi, is there anything?
I would just add that one cannot ignore the fact that 92% of our cash flow is coming from investment grade rating countries. I think we also have a very well staggered bond maturities. We're always very keen about that. I would say that in September 2015, our leverage was about 65% on the parent level company. We've taken some action to that, and we were down to 62. Post the 2 transactions that we've done late last week, we're going down to 55%, and I think the byproduct of our strategy is very clear to improve our credit matrix rating and further diversify our source of funding, which ultimately our objective is to get international investment grade rating. I think it's very much in line where our cash flow is coming from compared to where our debt coming from, which predominantly today is in Israel, at least on the debenture side. I think we've been very successful in the past 16 to 18 months where we diversify a lot of our bank debt into international banks. Doing that while we're reducing our cost of financing. So I think you're going to see a lot of those efforts going forward for fiscal year 17.
And if you look at our bonds in Tel Aviv, which are publicly traded, you can get on Bloomberg, they probably came in 100 basis points. The last thing I want to say about the sales of last week, I'm already at the age where you send kids to college and university. Just because your kids moved out of college and you turn in his bed and bought a little desk for work doesn't mean that you sold the house or that you got rid of the room. I want people to remember that this is not a value statement on the subsidiaries or the companies you own. This is Gazit specific agenda to consistently lower our leverage, and I think we're very much where we need to be.
Just quickly, are there any questions from the floor? Okay, so with a couple of minutes left, I'm going to move on to the rapid fire.
2 minutes for rapid fire? I can do 2 more questions. Okay.
Are there any more questions? So we'll start with what will same-store NOI growth be for your sector overall in 2018?
So for high-quality retail, I think 2 to 3%.
Okay. How much higher or lower do you expect private market cap rates for your sector to be in 12 months' time?
That is a complicated question. Flat.
Flat. And lastly, rank the best real estate decisions to make today. Buy, build, or sell?
All of the above.
Come on.
We have a portfolio big enough that some of the properties will sell. I think we'll add to the portfolio as we speak if strategically it makes sense, and we'll continue to build. That's my answer.
Okay. Thank you, Dori and Adi.
Thank you.